Most traders talk about support and resistance. But what if I told you there's a much smarter way to understand how price really moves? I'm talking about supply and demand zones, the same zones that institutional traders use to enter and exit the market without leaving obvious footprints. In this video, you'll learn exactly how supply and demand works, not in theory, but in real practical terms. We'll break it all down, what these zones are, how to find them, how to trade them, and most importantly, how to use them like smart money does. Let's dive in. To understand supply and demand zones, we need to start with the most basic question. What moves price in any market? The answer is simple: an imbalance between buyers and sellers. When there are more buyers than sellers, price goes up. When there are more sellers than buyers, price goes down. But here's where it gets interesting. Price doesn't move because of random traders like you and me. Price moves because of big players, institutions, banks, hedge funds, the ones placing multi-million-dollar orders. These players can't just enter the market anytime they want. They need liquidity. They need other people to take the opposite side of their trades. So what do? They wait for price to come into areas where there's a lot of activity, a lot of pending orders. They step in, buy heavily, and cause price to shoot up. Or they sell aggressively and cause price to drop. Those zones, where price makes a strong move after a base, are what we call supply and demand zones. A demand zone is an area where strong buying occurred, causing price to move up fast. It's where big players entered long positions. When price returns to that zone, it often reacts, because there may still be unfilled buy orders there. A supply zone is just the opposite. It's where strong selling happened, leading to a sharp move down. When price comes back to that zone, sellers may step in again and push the price lower. But not every bounce is a valid supply or demand zone. We're not looking for minor reactions. We're looking for imbalances, where price exploded away, leaving a clear footprint of institutional activity. Let me give you a simple example. Let's say price consolidates in a tight range, then suddenly moves 50 pips in one direction in just a few candles. That sudden move shows imbalance, and the area where that move started becomes our zone. So now you're wondering, how do I spot strong supply or demand zones on my chart? Here are 4 key characteristics to look for. 1. Sharp move away. You want to see a strong move away from the zone. Big candles, minimal wicks, almost no hesitation. That shows clear institutional interest. 2. Freshness. Has price returned to the zone before? If not, the zone is fresh. Fresh zones have higher chances of success because the orders inside them haven't been filled yet. 3. Time spent at the zone. If price stayed too long in the zone, lots of candles, lots of back and forth, it probably means indecision. You want zones where price stayed briefly, then made a clean breakout. Clear base. The zone should have a clean base of 1 to 3 candles before the breakout. That base is where orders were accumulating. If the base is messy or too large, skip it. Bonus tip: always mark zones that lead to breaks of structure. If price rallies from a demand zone and breaks a previous lower high, it adds confidence that the zone was legit. Let's talk about drawing the zones. Here's a simple method. For a demand zone, identify the last bearish candle before the strong bullish move. Mark from the low of that candle's wick to the high of its body. That becomes your demand zone. For a supply zone, find the last bullish candle before the sharp drop. Mark from the high of the wick to the low of the body. That's your supply zone. This method gives you the precise area where institutional orders were likely placed. Now, there's no universal rule about whether to include wicks or not. Some traders use only the body. Some include wicks. The key is to stay consistent with whatever method you choose. And always remember, the sharper the move away from the zone, the more valid it is. Now that you've identified a zone, how do you trade it? There are 3 smart ways to enter. 1. Limit order entry. You place a buy or sell limit order at the zone. It gives you the best risk reward, but it's aggressive. There's no confirmation. You're assuming price will respect the zone right away. 2nd, confirmation entry. You wait for a signal, like a rejection candle, a bullish engulfing for demand, or a bearish engulfing for supply. You can also drop to a lower time frame and wait for a market structure shift before entering. This gives you confirmation, but may reduce the R to R slightly. 3. Liquidity sweep entry. This is an advanced technique. You wait for price to sweep the zone. For stop loss, place it slightly outside the zone. For targets, aim for the next opposite zone. But the most important part is this. Don't force trades. Let price come to your level, show you the reaction, then enter with discipline. Let me walk you through a real example. You notice a base of 2 small candles, then a big bullish candle that breaks structure. You mark the last bearish candle before that move, from wick to body, as your demand zone. A few hours later, price returns to that level. You enter long. Your stop is 8 pips. Your target is 24 pips. A clean 1 to 3 risk-reward setup. This is the kind of setup smart traders wait for. It's not about trading more, it's about trading better. Here's the truth. Most retail traders trade based on indicators, feelings, and noise. Institutions trade based on price, levels, and intent. If you want to succeed, start thinking like them. Stop chasing price. Start waiting for it to return to areas where the big players left footprints. Mark clean zones. Wait for price to come back. Trade with patience, confirmation, and risk control. That's how real traders win. And now you know exactly how to start doing it too.